What's up everybody, Nate here. And for years now, Wall Street investors and corporations have been buying up millions of single family homes and office real estate all throughout the United States. But current problems in the housing market and our general economic conditions are causing the housing market and now those deals to essentially collapse. Blackstone, one of the largest real estate investment firms in the entire world, just defaulted on a $560 million loan. Not only that, but it has its own REIT called a BREIT fund, and it is limiting the amount of withdrawals that its investors can make because of our current housing market conditions. Hundreds of thousands of other real estate investors are starting to sell off their properties as well as the entire market starts to shrink. And this could ultimately signal something much bigger coming for the housing market in the days and weeks and months ahead. So what exactly is going on here? Well, when it comes to Blackstone and other real estate investment firms like BlackRock, these are really important corporations and companies that you want to be paying attention to, especially if you are a real estate investor or somebody that is currently in the housing market. These organizations are really important to pay attention to because they have had a huge impact on housing values and inventory over the last few years. When the pandemic started, the Federal Reserve essentially lowered their interest rates to 0% because they wanted to incentivize spending in our economy. Now that affects how banks lend their money because banks get their money from the Federal Reserve, they get their money from the United States Treasury Department. So the higher or lower those rates go, the easier or harder it is for banks to get their money, and that means they're going to make it either easier or harder for you to use their money. With interest rates going down to 0%, that means it was suddenly really easy for millions more people to qualify for a bigger mortgage. So now people went out in mass and started to buy homes, but real estate investors also went out and bought homes too. Like I said, you had Blackstone and BlackRock and all of these other real estate firms going out and purchasing homes. They have bought millions of homes over the last few years, and that has affected housing values because they are renovating these homes and then they're renting these homes out. So there's less supply on the market, which means prices are going to be a lot higher for the people who are looking to buy. And it was really difficult for a lot of consumers to get a house during this time when they're competing against a corporation, because if you get into a bidding war with another consumer, well, that consumer and that American is going to have some type of limit and budget for what they can put down on a house, but a corporation is going to have a much higher budget. So 9 times out of 10, they're going to outbid you and they're going to get that house. So that is what was going on in 2020 and in 2021, but this problem didn't start at the pandemic. No, corporations and real estate investment firms have been working together to purchase homes over the last decade or so. These real estate investors and these corporations see opportunities and then they jump on them. And the last big opportunity that they had was after the 2008 housing market crash. During this time, housing values dropped by sometimes 90 to 100% in some areas. So a $100,000 house was selling for 10 grand. That was an opportunity that real estate firms could definitely not pass up. They bought a ton of homes and then they renovated these homes, or they bought a ton of property and created rental communities, which has sort of forced a lot of Americans into renting because we don't have the supply and the affordability for many Americans to outright buy a home. Now, in a way, that did actually add to the supply of homes, because when these real estate investment firms invested in a corporation, well, then that corporation went out and bought land, and there were some situations where they were selling these homes outright. So they were actually building brand new homes and then they were going out and selling them. So that actually kind of stimulated the market right after the 2008 crash and made it so people could get homes when we really needed them. But the vast majority of these homes owned by Blackstone and BlackRock are for renting. So then, with all that being said, what exactly is going on with Blackstone now? Blackstone doesn't just own real estate in the United States, and it doesn't just own single family homes. It also works with a lot of corporations that own office units. In Europe, Blackstone defaulted on a $560 million bond because who it was actually working with to own these office buildings was no longer able to pay its rent. Basically, what you need to understand here is that there is a big network of these real estate investment firms and corporations. It isn't just one person or one company going out and buying real estate and that's the end of it. No, these corporations have backers like real estate investment firms, and then these real estate investment firms also package together a lot of these securities and then take them on the open market and sell them again. So they're basically making money from another investor. investment. So there is a huge spider web of all of these investments floating around across the world. And when one thing falls, that causes a ton of other things to also fall down. So that is the macro side. And then you have the micro side. So the reason that people are defaulting on their loans in Europe right now is because economic conditions are going down, affordability is going down, but interest rates are going up. When investors and businesses and corporations take on huge sums of debt like this, it usually comes with an adjustable interest rate. So those interest rates are going to be directly controlled by the government. In this case, in Europe, interest rates have been rising in a response to inflation, just like they're rising here in the United States. So when those interest rates rise, it's really difficult for these corporations to now take on new debt and to pay the debt they already have. If they're not making large sums of money to account for interest rates going up, then that means they're not able to make their debt payments. And if they're not able to make their debt payments, then they go into default. That's the micro side, and then it affects the macro side and basically kicks off all of the dominoes to start falling from there. That's not the only thing that's happening with Blackstone right now. It's actually limiting the withdrawal amount that its investors can make on their REITs. Blackstone has a $71 billion REIT that it calls a BREIT, a Blackstone Real Estate Investment Trust. Basically, it's a big share, so investors will put their money into a corporation that goes out and purchases properties, and investors make money through dividends on those properties. Normally, once you get your dividend, you can take out as much as you want, but Blackstone is actually limiting its withdrawals right now because real estate investors are starting to get scared of market conditions. If all of these investors were to pull their money out all at once, well, you gotta think that $71 billion would essentially disappear. And now Blackstone is going to have to try to find the money to fund all of its projects and to give the money back to all of the corporations that have worked with them. So it's limiting the amount that people can take out because it doesn't want to lose all of its money. But this is a bigger issue. Blackstone isn't the only real estate investment firm that is doing this, and you have other real estate investors who are starting to see the writing on the wall with affordability in the gutter right now and interest rates going up. This might not be the climate that real estate investors want to be in to own homes, so they're getting out. But you've got to remember, these investors own millions of properties all throughout the United States. So if they suddenly go out and sell, that is going to cause a domino effect on all of your lenders, and it's going to cause a domino effect in terms of prices and value. That could essentially crash home prices in certain areas of the country where there is a lot of rentals and a lot of homes that are owned by corporations. And what you've got to think here is, well, why exactly would a real estate investor want to get out? Well, the main reason for this is because they're seeing their tenants really get crunched financially because of our economic conditions. Home affordability is at its lowest point that it pretty much ever has been at in American history. So Americans are spending more and more of their income on their housing payment, and Americans are running out of their savings, and Americans are increasingly turning to credit cards and other forms of debt in order to make ends meet, which means their finances for the most part are extremely brittle. One thing sort of collapses and now they can't pay their rent anymore, and that affects an investor and it affects all of their different properties. And just like the situation with Blackstone in Europe, they're also facing situations similar to that here in the United States because the Federal Reserve is raising its interest rates, which makes it really difficult for them to go out and invest. It makes it difficult for them to invest in corporations, which means the supply of homes is also hurt here. And for all of the millions of properties that they own, well, that could cause a domino effect for those corporations because they're no longer able to pay their bills because their tenants aren't paying their bills either, because Americans aren't spending money because of things like inflation, prices going up, and wages basically stagnated. And at the end of the day, that affects Wall Street too. So the bottom line here is that some real estate investors are starting to get out of the housing market, but not all of them. This whole phenomenon of Wall Street and corporations buying homes is not going away anytime soon in the United States. Yes, there are some real estate investors that are pulling out of the market right now. These are investors that might have bought in at the height of the market, and corporations that may have bought and over leveraged themselves into way too many investments, and that could mean that those investments eventually start crashing down. But there's going to be an opportunity then for new investors to enter the market, because when prices go down, then it's a similar situation to what we saw in 2008. 2008, where now there is a lot of affordability back on the market. Right now, Wall Street and corporations own around 4 to 7% of all single-family homes in the United States, but that number is expected to jump to around 47 within the next 10 or 15 years. So right now, even if every single home that a corporation or Wall Street owned got sold, or the value suddenly plummeted because people in those homes were no longer able to make their payments, well, that would definitely be a hit to the housing market, but it would not cause an outright drastic crash because the majority of homes are owned by regular banks through the mortgage process and regular Americans. But this problem could get a whole lot worse within the next 10 to 15 years if they own nearly 50% of the entire market. And what I'm most concerned with is that we continue to see these booms and busts in our economy. Right now, we're in a potential bust period where there's not a lot of economic expansion going around. There's not a ton of business expansion happening because investments are also not there. We will again see a boom in our economy at some point in the future. That could mean even more houses get bought up by real estate investors. But if these investors become too over leveraged and they package too many mortgage-backed securities and they have too many properties all throughout the United States, and we see a big crash in the next 10 to 15 years, which is definitely possible, now you have all of those properties essentially going under. And that could cause an outright collapse of not only the housing market, but our economy. And that is extremely scary, but it's less scary knowing that you can actually do something about it. We don't know what's going to happen in the economy or the housing market, but the best thing that you can do is sort of stay up to date with everything that's going on in the business and financial world right now. Our team puts together a free newsletter 6 days a week, and you can subscribe to it by clicking the link in the description below and by subscribing to this channel because I'm breaking down financial news and financial education 7 days a week, every week. But the more important thing here is that you be careful in the housing market. You cannot prevent everything that's going on in the economy, and you can't stop the Federal Reserve from raising interest rates. But if you are in the market and are trying to buy a home right now, just make sure that you can actually afford it. You want to prepare your finances as much as possible because we don't know what's going to happen. So you don't want to over leverage yourself right now and buy a home that you might not be able to afford in the future just to have to give it back to the bank or default on your loans later on. And same if you are a current home owner. Right now might not be the best time to upgrade, or maybe it's a great time for you, but the point here is that you know your finances better than everyone and you understand if you are able to actually afford to move or if it makes more sense for you to stay in the house that you're in right now. Whatever the situation is, the more you can help in your micro situation, the better off the entire economy is going to be because you are financially responsible and prepared. Better and healthier economy starts with you, so stay up to date with everything that's going on, stay as educated as you possibly can, and prepare for no matter what happens in our economy, both good and bad. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.